Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to rip through Twitter, see what people are talking about and sharing on social media. It's most likely going to be related to three areas: commodities, financial topics, and or wealth building threads or topics. So let's get through here. Let's see what's going on. I'm going to interject my financial opinions as we go through it. And let's see what people are talking about. If you want to follow me, it's at @finding_finance. And if you want to join our community, it's finding-value.com. We do have a discount code going on called Holidays if you are interested. Check the description link below. So Sven says, New York Stock Exchange updated. Pretty clean. Rejection came where it needed to preserve the pattern structure, which is a rising wedge pattern to some degree. And we got the rejection right at that resistance line. Coming down again, he says, it's not like we haven't seen this movie before, throwovers included. Not making a massive bear case here, but I also want to keep an open mind as we head into 2024 and everything and everyone is bullish again. There are times to be bullish, and there are also times to lighten up and evaluate as things develop. You can see these crashes here before the increasing wedges. So they're rising wedges, rising wedge or channel, rising wedge, break, and the little throwover. Is something like that coming? And also keep in mind, this is on the right-hand side of something that has rolled over. So I look at this, guys, and it gets me a little bit nervous. I'll be honest. I feel like we're treading in water that we've never treaded in before. It's not that we can't swim. It's the fact that, think about how rates got here. Just think about how interest rates got so high. It was from fictitious stimulus money entering the system, a whole gobload of it. And it pushed rates most likely to a level that the market would have never pushed these rates this high without the stimulus money. And we've been at very low rates for a very long time. So there's a lot of things that need cleansing out of this system. So, when I look at this and I see how bullish everyone is, it does scare me a little, I'll be honest. And the patterns and the way that it looks, I don't like the way that a lot of these patterns look either. But again, the yield curve's inverted. We'll see if people run into bonds. If they run into bonds and we see a strong move of bond yields declining, which we kind of are seeing a little bit of that. Generally, if a crash is going to come, we would see it after the first rate cut. That is the general rule of thumb. And if the first rate cut is coming March 24, well, maybe we go up, maybe we go a little bit higher here in the short term, maybe we don't. And then I just look at all these charts and I just get a little bit nervous because interest rates as high as they are, with the patterns that look kind of like this in the S&P and New York Stock Exchange and Nasdaq, they've been going quite vertical. And whenever things go vertical, that's almost like the end of trend move. It's things feel best before they bust. I'll just say that, okay? So I'll end it there. Coming on back, embryonic resilience being showcased by gold versus the S&P 500. And this is the S&P hourly chart. I know it's on a really short-term basis. We had a nice little false breakdown here, and then the slingshot to the upside, where gold is starting to outperform the S&P 500. And I think that's where, if we were to see an outperformance of an asset in conditions where we see a decline or a slowdown or something like that, gold would start to outperform the S&P 500. Gold's going to start to outperform basically everything if that market condition comes. And that's what I've seen in history, and that's most likely the spot to probably be. But we'll continue to monitor it. We'll see if we get further upside for gold and silver and see how that works. Now here's silver too. This says, now this is also has been unfolding its baby steps here. So this is silver versus the SPX hourly chart. Downtrend line break up against resistance, and we just broke to the upside also of silver outperforming the S&P 500. And that's where I'm most bullish. Gold and silver, physical metals, and maybe even the miners could do quite well here. So that is where I'm kind of looking there. HZ, it says the end of an era, lost decade coming for tech. And I do agree with this. This is the Nasdaq divided by the Russell 2000 ratio. We can see that this is very high with potential lowering. Maybe this is a double top. We can see this kind of Batman pattern going on too that's been overthrown here. A little bit of an overthrow top and maybe a move lower in the Nasdaq versus the Russell in this ratio. So that's something also I find kind of interesting. Silver, Peter says, silver cumulative deficits of 21, 22, and 23 equal 474 million ounces, nearly 50% of 2023 total supply. Projected deficit by 2030 is 120%. So when we look at these deficits, this is incremental. And what he's showing is this is the metals market balance as percent of supply from 2020 to 2030. There's some pretty big deficits here. The biggest deficit of all of them is silver. We also have large deficits in platinum, cobalt, lithium, nickel, copper, and aluminum. And I have investments in each one of these, aluminum, copper, et cetera, et cetera. You can see that we're coming to an inflection point for aluminum here very soon because 2025 is that middle one. So we're running a deficit here in aluminum. We're running a deficit here in silver already in 2020, 2025, and then massively out towards the second half of the 2020s. And then in platinum, it looks like we've got a small surplus coming around 2025 and then deficit from middle of 2020s to the end of 2030. Copper's path to $15,000 a ton in 6 charts. Let's check this thing out. Copper market starts in 2020s in an already tight state on post-pandemic demand surges. So we've got a very tight in terms of inventories. We've got an acceleration in green electrification trends is set to drive strongest decade in copper demand growth. Look at the demand growth here, guys, for copper. It just goes straight vertical. I hate to say it, but we don't have the projects in the pipeline for that type of demand. Mine supply will fall well below demand after 2024. So after 2024, that's our turning point where we go into a deficit, and it becomes a very large deficit, driving largest long-term supply gap on record. The largest long-term supply gap. With these trends at play, if copper prices stay at current levels, depletion risk is real by 2023. A sustained rally is needed now to mitigate that risk into the mid-decades. It says, we believe in a long-term copper price near 10,000 a ton is needed to incentivize necessary volume of probable projects to solve deficits towards the end of the 2020s. So that's what's going on there for copper, and it's starting to heat up in 2024, which is, well, that's only a few days away, guys. It's a week, about 2 weeks away. Agreed, this ratio is bottomed out and is starting to turn up, and the precious metals sector will most probably lead the next inevitable leg up for metals and mining. This is GDX divided by GLD. We've got a breakout, a false breakdown, and now he's looking for a move higher. So he's looking for a break above the black line where the real fireworks begin in this ratio. We've got a breakout and a back test for gold on the ETF, GLD. And then GDX, the large gold miners, We've got a breakout and a back test of a near term downtrend line is what he's showing, even though I don't really agree with that downtrend line. But maybe we come back a little bit more, it's possible, and then rip it. I don't know, but I'm positioned for it. And what this means is that there's probably going to be money or liquidity coming into the system at some point for whatever reason it is. Over the last 4 weeks, U.S. oil production is at 13 million barrels per day. We expect U.S. oil production to fall to 12.8 million barrels per day by early first half 2024. So they're expecting oil to actually fall coming up. And you can see that we've been coming on up. I know the rig count is way down, spending's down, and maybe we've got something going on here with production and a decline in production. Here's Athabasca Oil. This is one of the companies that we are invested in the community. We've been in it. Well, I've been in it since 16 cents. I've been in it since like right here of 2020. And I've been riding it the whole time. We just broke the downtrend line here, and we've got a price projection of 850. 850 on ATH.to. Housing starts in the U.S. were expected to decline by 0.2% last month. Instead, they skyrocketed by 15% to their highest level since May of 2022. In single-family homes, housing starts jumped by a massive 18% last month. Still, this data does not reflect the drop in mortgage rates that we've seen this month. The average rate on a 30-year mortgage is back to 7% for the first time in 4 months. If rates fall further, housing supply is coming fast. And I think there's also demand that would be coming fast if rates continue to fall and first-time home buyers really start to kick up where they can afford things again. What's mind-boggling to me is how uranium is world's top-performing commodity, brewing up the best cuppa that investors would normally be eager to drink, but instead they're dumping that brew so they can read the tea leaves instead to decide whether or not to buy a cuppa. And there is uranium futures heading on higher still at 89.20 is what we've got for a last reading that John's posted here. Massive underweight in commodities. What is going on here? So the most underweight commodities versus bonds since March of 2009. March of 2009 was the bottom of the commodity of the commodity market and the stock market. March 09, I remember that completely. I bought Tech, I think it was Tech, Kaminko was the name of the company. I got it for like $2 or $3 at that time frame, and I rode it all the way up to, I think it was like $20 or $30 somewhere. I can't remember the exact spot I sold. 20 something bucks probably at that time. But yeah, maybe this is a bottom. Maybe we're going to turn back up. I don't know. Maybe we still have a little bit more bearishness to go. Here's one responding to me. He says, I mapped your housing market thesis using Strauss-Howe generational years for boomers and millennials. I assumed home buying years between the ages of 30 and 40. It was very interesting to see that each time we go in and out of a purple box, the trend changes. So trend downtrend to an uptrend to a downtrend to an uptrend. So the demographic is really pushing this around in terms of housing starts. And it's also the demographic interacting with an overbuilt and underbuilt scenario. So yes, I think we're going to continue to go higher for housing starts based off the demographic. You are correct. Zoom in on the period between dot-com collapse coincides almost exactly with the last baby boomer turning 40. Then we had a property blow off, but there was no demographic supporting it, just low interest rates in the orange, so it collapsed. 100% agree. What they did is they lowered rates, gave everybody free money, pushed this to as high as they can to create a housing bubble, and then it all collapsed. We went into a very big hyper supply phase during that time frame. I don't think we're in that time frame, or I don't think we're in the same situation that we are in today with the millennials interacting with the housing market. We are short so many homes. And I don't know why people want to fight that. It's like, oh no, there's homes out there. Okay, whatever, guys. go look at the data. That's all I'll say. Continue to look at the data. They'll pull up people owning multiple homes, like those homes are going to be available for sale. I don't see it, guys. I'm sorry. That says you might reasonably ask, where is Gen X? Through analyzing birth patterns, I found that a boom generation is born in two waves. And then there's a bust, which we call Generation X. The bust after the millennials, the true Zoomers. Correct. So you go in this box here of an increase of demographic, the increase of population growth. And then you can see it dives off after that quite dramatically. That's going to be a problem. It's just like China. Their demographic just went through a bunch of home buying years, and then it dove after in 2020. And they're having a major problem with their real estate market right now because of the demographic. The demographic is what drives all of this. So that's what I'll say there. We've got emerging markets are down around 80% versus the S&P 500 over the last 13 years or so. Correct. And the reason that is you don't have high inflation. It's a recovery phase of real estate. And whenever you go into that type of situation, the S&P 500 or Nasdaq does very well. Does very, very well. Historically, during soft landings, the S&P 500 rips in 6 months leading into a first Fed cut. Would put the market at 5,200 by May. First time speaking with great guest this. So when rates come back down, the market runs after those rates are cut. So it says stocks average 10% in 6 months before the initial soft landing cut. So first cut of the soft landing is here, and you can see the cut, and then it ran back up, and then we get a potential larger sell-off after that. Job openings are collapsing, and that is something to worry about. You can see the job openings collapsing before a lot of these recessions. Is a recession going to come soon? A slowdown in the market? I don't know. But a lot of data does point to a slowdown, while other data does not. And it's very difficult to know the weighting that someone should put on some of this data. Like, should we overweight job openings or should we overweight unemployment? And I would think you'd want to overweight unemployment, but I would expect that this is probably a leading indicator showing that a slowdown is occurring. The market feels, well, weird right now. I wouldn't necessarily short this market here, but at the same time, I wouldn't be buying if I was already long. Anyone else feel like this? I do. I feel like, I don't know, I just feel something weird as well. Like, I look at the markets and I'm like, I mean, there's some good areas to look at. I'm definitely very bullish on the precious metals, but that means that I kind of think that a slowdown is coming at some point in 2024. I'm not stating immediately, but whenever you raise rates, and you raised rates with money that we just made up out of nothing, I understand that the real estate market can do the same thing, but I mean, the home sales volumes, guys, they have literally gone to like nothing. So the rates, in my opinion, are probably too high, and they're probably too high for just about everything, which makes me think that I feel like there's a delayed slowdown, and the slowdown is coming to some extent. Like, that's just kind of how I feel when looking at things. Are we really going to surge higher with the S&P 500 and a lot of these stocks when, home sales volumes, they were really, really low, but I guess maybe fiscal spending can carry us forward. It's just a weird, I don't know. I feel like it's weird. I feel like we're slow-mo, going through a bunch of things in slow motion. That's kind of what I feel like. But I don't know. I'll keep looking. Brazilian equity markets have experienced near record foreign investments in the last month, despite all the skepticism about EWZ is outperforming the S&P 500 by 23 percentage points in the last 2 years. So foreign investments are increasing into Brazil. Brazilian equity markets. We've got Scott here, CCJ Uranium. What second leg looked like last cycle versus now? The 50-day moving average worked beautifully. Most smaller names ran in the last parabolic pop that last 1 to 2 months. So this is then, back then, you can see what this kind of looks like. And then now, uh, where we're hitting that 50-day moving average. So this was 2005-ish, and we still had a lot to run even after that. So that's where he thinks we're at, kind of 2005-ish. Perhaps. Why price targets are meaningless. The Goldman Sachs price target versus actual for the S&P 500. This is the change and the changes that they made, and this is the actual that occurred. So the price target, the change or difference, I guess, between actual and price target, and they're not really hitting it that well. So I don't put price targets on anything. I think it's just a waste of time. And this is the reason it's a waste of time, is because no one can accurately predict anything. Bank of America is looking for gold prices to push $2,400 an ounce in 2024. Saxo Bank sees gold prices hitting $2,300 an ounce. Wells Fargo said that it's watching for $2,100. Fed signaled 3 rate cuts in 24, which will be positive for gold. And I agree with that. It's going to be positive for gold. The price projections, in my opinion, aren't important. It's what are you bullish on? And what market conditions does certain assets go up and down in? And I think they've nailed this. Gold goes up when rate cuts come. Longtime fund manager makes a bold call, crude oil prediction for 2024. With Russia and Saudi Arabia conspiring on production cuts, the price of oil exceeds $110 a barrel, and the price of a gallon of gasoline in the U.S. approaches $6. That's somebody's guess. Most bullish bonds in 15 years. We can see most bullish in December of 23 and March of 09. And I will say that March 09 marked the bottom for stocks. Right now, December 23, stocks are way up, but people are most bullish in bonds in the past 15 years, and that's crazy. It's crazy to see that. Anybody watching the Canadian dollar waking up from the abyss? Oh man. So we've got the Canadian dollar, and then this is silver priced in. So Canadian dollar is this one here. And then we've got silver, which is the top line up here. So as the Canadian dollar goes up against the US dollar, we see a move in silver. And we just broke out of the wake-up line here to the upside. And then we've got the critical pivot line. That's the horizontal line that we still need to break. If you notice, the Canadian to US dollar, if you look at this, is the same as the XAU to gold ratio. It is literally a very similar chart. You could probably draw this across too, and it's going to be a breakout for the Canadian dollar. So hopefully this is an early sign that silver is about to rip it to the upside. Here's Grady. Of course, he's got a silver chart leading right into silver. Big picture, silver has a fantastic chart setup. 14-year blue symmetrical triangle, perfect green rounded bottom touches. False breakout done, so no need to go back there again. And had a breakout in November. Now most likely back testing. So we're probably ready for a big launch in gold and silver. What does that mean? It also means that we could see a slowdown in the market. It also means that we could see rates go down, which we've been seeing. So it all kind of correlates together. And that's where I'm going to end it, guys. That's what I've got for today. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you like. But yeah, I do feel like the market's a little bit weird. I don't like seeing some of the patterns in the market, like the Batman pattern is what I'm seeing in the S&P and Nasdaq. But again, we'll see how it rides out. We'll watch interest rates, see how they behave over the next few months. And maybe they'll give us an early indication that if something does come, you'll see those rates dive. But right now, I'm going to remain bullish until I see that. All right, guys, we'll catch you later. This is Finding Value.